In March 2023, three banks went under in 5 days, and it caused a huge drop in global bank stock prices. It got people really worried about this happening again in the future. Now, there are two main things that make financial crisis like this more likely. Okay, let me explain it to you. Number one, interest rate based debt contracts, and number two is fractional reserve banking. These factors make it easier for banks to collapse, and the whole world can feel the impact. So I'm going to show you what's happening, okay? In this video, we're going to get into those articles associated with it and what's happening right here. But let me just break it down. Interest rate based debt contracts are pretty common in the financial world, but they also make things unstable. When interest rates go up, it's harder for people to pay back their loans, which makes banks lose money. Then you could see that you can create a chain reaction where banks get more cautious about their lending, and that can make economic downturns even worse. This is the tightening that I discuss all the time. The other thing is fractional reserve banking, and I'm sure you already are aware of it, but it's when banks only need to keep a small part of their deposits as reserves. This lets them lend out more money than they actually have in reserves, which can keep and actually lead to massive growth in credit. But if people lose faith in the bank and want their money back all at once, the bank might not have enough reserves to cover it, which can cause a bank run and maybe even a collapse. Does that sound familiar to you? Well, here we go. Right now in 2023, that happened. SVB was solid the month before. All the analysts were saying buy, 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 and you saw what occurred. Now, I'm going to explain this in today's video. I want to show you all the details. You came here for the truth, so let me unveil that for you. Right here, you can see the regional banks have so far held on to deposits better than investors might have feared, but they still bear some scars from a difficult quarter. So certainly you could see that chart right there just showing us change in deposits from the end of the fourth quarter to the end of the first quarter. Global banks, regional banks, all of the US banks. In terms of percentages, I mean, you could see it isn't like as if everybody started to pull out their cash, but it does hurt them. And you can see how some companies get hit so hard so fast, right? Companies started to look very bad in the grand scheme of things, but here we are today, okay? Look at this. The current bank crisis is in the second or third inning. It's not the seventh inning, according to Kaplan. And he thinks that the Fed shouldn't raise interest rates until it has a better view of the fallout, particularly because it would be damaging to have to cut rates later this year to address a bigger crisis. Quote, I'm afraid that we've got something coming that we don't fully understand. So you could see what has happened over the last little while. There is a big concern, and these things come out of nowhere seemingly. And here we have it. Of course, the Federal Reserve has been trying to expand their balance sheet. They're lending out money. The banks have been doing what they need to stabilize this system, knowing that it's all based on this accounting fraud, essentially. That we don't have anything in the bank, that when you go to take out a few $1,000s in cash, they say, well, we don't have that. And that's the kind of thing that we're dealing with right here and now. It's unfortunate because it's unstable. At least 9 lawmakers sold bank stocks during turmoil. Now, while they'll tell you that this is, they essentially want to pinpoint, who's behind it and so on. In my opinion, whether they can buy or sell or anything, they can always get somebody else to do it, and there could be something going on behind the scenes. This is not the resolution. This is what people try. They just want something. Give me something. And that's what happened with Dodd-Frank, and that's what happened with Glass-Steagall. But what occurs every time they put one of these things in place? They just reverse it a few years later. This is not the solution. Having interest rates at a moderately high level for a considerable period would eliminate a lot of these things because the speculation starts to go away. That really is one of the primary solutions. Don't have a balance sheet of $9 trillion. Okay, don't give out billions and billions of dollars to banks. And at the same time, keep interest rates at least a moderately reasonable level. Is that so much to ask? Okay. Here we have this next article, which is essentially saying that the administration is moving to make it easier to more closely regulate non-bank financial institutions such as hedge funds and money markets, proposing a rollback of what they saw a few years ago. Because why would you want to roll back any of these things? The assumption here is that, you want the banks to grow, you want money to be lent out, you want more investment, you want more capital, all these different things. And they want more scrutiny, but they're not going to get it. Okay, that doesn't happen. And of course, they will not be able to catch anything before it occurs. That's just a simple matter of fact. Okay, so they're going to designate what is systemically important, and then they can go beyond these, just the so many that they have, and then what they're thinking is that, okay, then we can have more scrutiny on them. They won't. The way that the IRS operates is about to undergo a major change. Here's what that means for you. If you want, you could read it, but essentially, they say that they're only going to go after the people who are making $400,000 or more. But we know that's not the case. They are hiring, or have hired, I think it was 87,000 new IRS agents, and they want lots of audits. So they can determine, the time on your watch. They could look at anything that you've ever done before, top to bottom, but they can't figure out what income you made. We know that's not the case. Come on. This is silly. This is another way to enforce the rules and control on the government, to make big government even bigger. This is not going to benefit people. You think you're going to get more tax money and you're going to be able to get the people getting out or not paying their taxes. This is ludicrous. The people that pay the most taxes are the ones that, basically the people that are making the most money are paying the most taxes by far. This is a very broken system. You got to realize that. Okay, we need to cover this really quickly. I want to talk about real estate here, especially with the investing aspect. Americans escaping pricey cities bring higher housing costs and inflation with them. And this is what a lot of people I've heard from you in the comments saying, basically, you're from California, stay there. You're used to your housing prices. You're used to your politics. You're used to, all of that, what you do, stay away. So that's what some people are saying. Inflation in some warm weather metro areas is more than 2 percentage points higher than the national rate. But of course, we see this all over the place, where during 2020, people decided that they weren't going to live where they were. It was too expensive. They were allowed to work from anywhere. And so they went to these smaller places, and those people in those towns were saying, hey, what are you doing? We can't deal with this. The prices are elevated. We can't, handle all that. But they did anyway. So now we're dealing with that, right? The commercial real estate market is wobbling, and two of its largest players are feeling the pain of higher interest rates and tighter credit, just simply highlighting the fact that Blackstone reported big losses in the past quarter, and Brookfield reportedly defaulted on some of its loans. So when you increase interest rates, you do create a problem. I've been warning about commercial real estate much more than the residential real estate for a while. And here we have some of the cracks that have started to appear. We'll see what happens with interest rates. And then we have this, I thought it was crazy, but when you're trying to get a loan, this is crazy. Look at this. What are the fee changes? The entire matrix of fees based on credit scores and down payment has been updated. If you have a top credit score, you'll still pay less than if you have a low credit score. However, the penalty now for having a lower credit score will be smaller than it was before May 1st. For example, if you have a credit score of 659 and you're borrowing 75% of the home's value, you'll pay a fee equal to 1.5% of the loan's balance. Before these changes, you would have had to pay a 2.75 fee. So essentially what's happening here is this is going to allow people with lower credit scores to get more debt. That's a simple matter of fact, because they're saying we need more affordability. And so if they have bad credit or worse credit, they would have to go to a B lender, which has higher rates. Maybe they'll have to borrow money in a different way. So now they'll be able to handle that better. However, there are rules in place for a certain reason that were there, and I think this could actually expand and make things ultimately worse. But we have to see and we have to judge it as time moves on. London landlords abandon market as mortgage rates erode profits. Soaring rents fail to cover mounting costs in the buy-to-let sector. So if you want to rent out and then eventually to buy, landlords basically just can't keep up. They can't pay their debt. Do you see the problems here? It's not just Blackstone and Brookfield, and in this case, companies, small businesses in London are feeling it. It's going on everywhere because when interest rates rise, that puts the impact on everybody. Do you see how there's a domino effect? What we saw with SVB was pretty simple. You had interest rates rising that flipped everything that they were dealing with, the mortgage-backed securities. At the same time, you had all these depositors starting to rush for the exits, completely collapsed the company. This could happen to any company. It could happen to a small company. It could happen to a big one. Regional lenders, they are saying, hey, everything's okay. But some individuals, even those former officials at the Fed, are saying, we're not done yet. And that's why they're warning that the Federal Reserve has to stop right now with interest rate increases. May is a big, big time for the Federal Reserve. We're going to see what actions they take, or maybe decide not to take. All of that will be here on this channel. You got to hit that subscribe button. I'll see you tomorrow. Take care.